Hey, welcome to 75 Personal Finance. Today we're going to talk about Singapore Savings Bond and whether you should subscribe to this month's SSB. Now, what on earth is Singapore Savings Bond? Well, it is a savings bond by the Singapore government, and I realized that wasn't really very helpful. So SSB is actually this instrument that the Singapore government introduced to allow individuals to save for the long term. It's basically a bond that you buy with the government, and your capital and returns are guaranteed by the Singapore government. You can actually redeem anytime you want without any capital loss, and any accrued returns are actually yours, guaranteed. So you need not hold it for a period of 10 years if you want. You can hold it for 1 or 2, or even like half a year or even 1 month if you want. Please note that this is not personal financial advice, so do your own due diligence. And this is also not sponsored by the Singapore government, although I wish it were. Lawrence Wong is a great candidate to choose, and I think he'll be a great Prime Minister, the best. A new SSB is announced every first working day of the month, and this month you can actually apply for the May 2022 bond. And the interest rates are as follows. It gives you 0.86% interest in the first year, 2.13% interest in the second year, 2.20% in the third year, and so forth. So over the 10 years, you can see an average per annum return of 2.09%, which is the first time the Singapore Savings Bond has actually exceeded 2% since I think sometime in 2019. For an illustration of the returns, if you place $10,000 in this, you'll get $86 in the first year, $213 in the second year, and then over 10 years you get about $2,103, which makes an average return of 2.09% per annum. When you buy an SSB, interest is paid to you every 6 months and is guaranteed according to the bond that you bought. So let's say we are buying the May 2021, which has an interest rate of 0.86% for the first year. You're actually going to get $86 over the next year, and this is paid twice, once every 6 months. And even if you terminate before the 6 months is reached, you still get a prorated interest. This is about as safe as it gets where investments are concerned because they are backed by the Singapore government. So the only way you're not getting back your money is if the Singapore government collapses. So I guess that depends on your political view whether it's possible to happen or not. Now, even the shorter term returns are not too bad, I feel. If you can hold it for at least 24 months, you actually get 1.49% per annum return. And if you can hold for 3 years, you actually get 1.72% per annum. Considering how the interest rates of many savings accounts and insurance savings accounts have decreased over the past couple of years and never recovered even though interest rates going up, this may be a viable option for you to place funds in the short or even long term if you wish. And if you terminate, there's actually no penalty. All you have to do is pay a $2 application fee to withdraw your funds. And that's quite low, I guess. Hey, if you like my stuff, press the like button and go over to satisfy.com/deals. You won't regret going there for attractive sign-up gifts. And thank you for keeping my channel going. If you wish to apply for the Singapore Savings Bond, you can actually use cash or even your SRS savings for it. So you can go to an ATM and annoy a lot of people behind you as you press all those buttons, or apply online like a sane person and use your cash or SRS savings to buy the Singapore Savings Bond. Each application has a $2 fee to pay, and this is non-refundable, and you also have to follow the application timeline as follows. You can start applying for the bond from the first working day of each month up until the 4th last working day of the month. Allotment happens on the 3rd last working day, and on the following month, the 1st working day, you will get your bond. There is an allotment process because you may not get the full amount that you subscribe for if the particular bond is oversubscribed for the month. I can't remember the last time it happened because of the low interest and therefore low popularity of the bonds in the past few years. I cannot remember the last time it was oversubscribed. But if it does happen, they have a process. When a bond is oversubscribed, what happens is that there will be a cut-off amount, and people who have applied for less than a cut-off amount will have their application fully filled, while people who subscribe to more than a cut-off amount will have to get their subscription filled on a random basis from any leftover allocation. Unless you're going to invest a very large amount, let's say more than $40,000, I don't think you have to worry too much about oversubscription. I think the last time this happened, it only happened once, and the amount cut off was about $41,500. So unless you're going to reach this amount, chances are your subscription amount is going to be completely filled. If you want to redeem a bond and get back your money, there's actually no penalty for doing so, but each withdrawal request has a $2 fee again. And you have to follow the timeline as well, so it's not completely liquid. Withdrawal requests can only be submitted from the first business day of the month, and you have until the fourth last business day of the month to submit your withdrawal request, and you will get your money by the second business day of the following month. This means that if you were to withdraw your funds towards the end of the month, you have to wait about a week or so. And in the worst case scenario, if you decide to withdraw at the start of each month, you actually have to wait almost an entire month to get your funds. So do note that this is not 100% liquid, even though there's no penalty for withdrawing your funds. If you withdraw before 6 months or 1 year is reached, you still get the prorated interest. So you don't lose out on the interest if you were to buy this and then redeem it as early as next month. You still get your interest prorated and given to you. So there's no loss there. So it actually is quite a good place to put your emergency savings as long as you have at least 1-2 months in your bank which you can withdraw anytime. Because remember, this actually has a timeline to follow if you were to withdraw your money. Now that the rates have recovered to this level, I think that this is actually quite a good place to put your funds in, especially if you have been relying on insurance savings accounts and bank accounts which have all fallen in interest rates over the past 1 or 2 years or so. So it is a very good place for you to put money that you do not want to place in high risk investments. It is also a very good alternative to cash management accounts that robo-advisors like to provide. And all my cash management accounts are actually underwater over the past 6 months. So I might as well just put money into SSB, which is guaranteed. And for 2 years, it's actually not too bad rate for something that's 100% risk-free. It is also applicable for SRS funds, which is perfect because I have some money in SRS, which I dollar cost average into the market every month. But those idling in the account, I think I will put into this rather than cash management accounts of robo-advisors, which has the potential to lose money. So you have been contributing to SRS to cut down your tax payable and have amassed a certain amount of money but have not invested at some. Maybe this is something I look at, but I think over the long-term horizon, you should still be investing the bulk of your SRS into higher risk equity market. But it's still a very good cash management place for you to sit your SRS funds and then slowly DCA into the market. Now, everybody knows that interest rates has been rising and will continue to rise in the foreseeable future. So next month's bond is likely going to be better than this one, and the month after next would probably be even better. But you can still buy this month's bond first, and if next month's bond is really better and you want to reallocate the funds, you can always just terminate it again and then buy the new one. Of course, there's a $2 fee for application and $2 for withdrawal, but that's quite a small amount to pay if next month's bond is really much better. So that is the advantage of SSB. It is almost completely liquid, subject to the withdrawal timeline. Ultimately, I will not put too much money to this because the rates, although better than before, are still lower than inflation, and in real terms, you are actually losing out value of your money. So this is only somewhere I see as a short-term place to park some of my funds while waiting for investment opportunities. Are the rates attractive enough for you to place money in the SSB? Let us know in the comments below. If you have any questions, feel free to leave it in the comments below as well. Drop me a like if you like my content, subscribe to my Telegram group for more content and great deals, and I'll see you next video.